Good day, folks. Let's talk shop about these dividend stocks as we review my $370,000 Canadian stock portfolio for that juicy passive income as I made some major moves this week. But I want to broad view the markets because Canada, US, China, the biggest movers are these dividend stocks. So if you're on a path to financial independence, you damn well one day want to retire early, join me, folks. It's one of the greatest communities on YouTube. Just simply hit that subscribe. We're going to do this together because I'm going to offer full transparency unlike any other YouTuber out there. And getting into it, look at the markets, man. This week we saw some of the biggest moves out of the most volatile tech companies like Palantir doing 20% mood swing. Some of our two largest single stock positions between the wife and I, Google, Meta down pretty substantially along with Amazon, Tesla, a lot of tech volatility. But when you look at the rest of this chart here, what do you see, baby? You see some dividend movement, especially when you zoom in over here. If you take a look at like Pepsi, Coca-Cola finally rebounding to the tobacco giants, man. If you take a look at Hershey, Mandalay, these stocks we were just talking about, and even Constellation after Warren Buffett just bought it. Some big moves here. And we're going to come back to that because it really plays into SCHD, which is now keeping up with, dare I say it, the S&P 500 this year after lagging pretty substantially, but a place that I've been holding strong. If we take a look at the Canadian markets, similar volatility, man. Tech is having a hard time catching a bid, but there's no surprise when you look at Shopify, for example, after these stocks went on absolutely historic runs. I mean, tech has just been going parabolic, and I'm not typically a person that wants to be chasing. I like looking for these discounted opportunities that at least I believe exist in the market, but mostly through ETFs. Let's be real, but we're seeing some really good rallying again in TELUS, unlike Bell, but TELUS is up again this week, kind of hitting new yearly highs, which is great to see. Manulife posted crushed earnings. We'll talk about that. That's up. The railways are up, with the exception of a few energy stocks like Enbridge, which again ran pretty substantially. I mean, this is a good market to be in for income oriented investors, right? So we take a look, the S&P 500 is up 3.66% this week. The TSX is up 1.89. And one of the most fascinating markets outside of what we're used to is obviously Chinese stocks, which have finally really started to rebound on recent earnings. And these are stocks I'm kind of regretting not buying into. I've talked about this multiple times. I just only have so much capital, and where I want to allocate it is specified to my own personal interest. We'll discuss when we take a look in full transparency into the portfolio. But Alibaba, man, is up 70% now since the beginning of the year. If we zoom in on a 5-year, they're finally starting to rebound to some 5-year highs that it's crazy for those that have had to sit through this wild, volatile roller coaster. I've seen a lot of YouTubers across the board highly disappointed, taking, basically losses, tax loss harvesting at the lows of these stocks, really missing the recent rallies. But again, this is why I think it's important to look at global market ETFs, because if you look at those global market ETFs like VT, it is now actually outpacing basically VOO. And that's just because there's so many good stocks in here. I mean, you look at things like Nintendo, a lot of global markets with mega cap companies are starting to rally because they're mostly trading at discounts. And I've told you guys this as a Canadian investor that lives outside of kind of the US bubble. I recognize that, there's better value for US investors in the global markets because you're getting a way better dollar conversion. And if you're taking advantage of it, you could see a really tail-ended return when interest rate cuts come, which will likely lower the value of the US dollar. But look at Alibaba here, man. This thing just crushed it. I mean, when you look at net income up 333%, I mean, diluted earnings up 261%. This company is in full turnaround. I mean, their earnings tanked their price to earnings multiple, and the stock is still trading at highly favorable values. Like I'm saying, like even Alibaba is still considerably cheap if you don't mind investing into foreign markets, which I think with a lot of the U.S. politics, foreign policy that's going on, geopolitical events, I think a lot of people are looking to continue to diversify out of the United States. Maybe it's just my personal opinion. I'm still mostly invested in the U.S., but you could really look at things like VT to get those global market exposure, still upperweighting the U.S. stocks, which I still think are going to prove resilient over long periods of time. If we switch to the Canadian markets, we saw Manulife post, and it absolutely crushed, again, increasing its dividend, which I'm sure a lot of investors are extremely happy to see. If we take a look, they increased the dividend 10%. Double-digit dividend increase, which is insane. And I love that I get the exposure to this in my VDY ETF, which, like I said, Canadian dividend stocks like the banks, they're like Pokemon cards. There's very few of them. You kind of want to own them all, and it's just easier to do it through an ETF because the dividend growth here, I think, is just absolutely astounding. But core earnings were up 8% here, folks. I mean, EPS up 11%, a high single, double-digit between revenue and earnings. This has got investors extremely happy, right? So that's kind of the biggest movers of the week that I've seen so far, and I might be missing a few, and I'd love to know what ones interest you the most in that comment section below. And if you want to talk one-on-one, if you want to join my chat groups where we go on about this stuff relentlessly, and also if you want to get my portfolio trackers you can literally use on your phone through iCloud numbers if you have an iPhone, go to kylelivingston.com, link in that description below. But my portfolio is now up 3%, which it did hit here, I think, a little earlier on. But I mean, we're in a really great place, I think, since the beginning of the year. And I reset my entire portfolio value so we could actually track it against the S&P. Now, we are lagging the S&P 500 so far this year. But again, I'm not complaining being up 10 Gs. Plus, I'm going to be getting really decent dividends in the first quarters coming up in March, which means we should be getting some really fat checks from things like SCHD, perhaps the S&P 500 here. So lots to look forward to from a dividend standpoint. But my biggest moves have not been in the realm of dividends. Obviously, we bought TELUS back since the beginning of the year. And if we take a look at TELUS, it is up 12% now, but again, I didn't catch it right at the beginning of the year. We were buying it around $21.50, give or take, I think is the cost average since I bought it. But outside of that, my biggest movers have, again, not been in the realm of dividends. It's been in Take-Two Interactive. And many of you know this is going to be probably my biggest trade of the year. Grand Theft Auto, going to sell 100 million copies, I'm hoping at least. Company's going to take their entire bottom line to full profitability, probably 3x the revenue from here, estimating the market cap somewhere between $50 and $100 billion. If you're not a gamer, I get it. This might not be a stock for everyone, but I did buy about 25,000 CAD worth of the stock just within the last couple weeks. I do want to scale this to probably about 10% of my portfolio, but keep in mind, I do own a sizable amount invested in a piece of real estate here. You know, my wife's got her own stock portfolio. Again, I usually don't want to make stocks any more than 5% of our combined portfolios. And right now it's sitting in a very good position, but I don't mind extending it a little bit farther with the hype that I think that game is going to bring, being the most valued piece of media entertainment. But putting that aside, I'm very thankful to have some cushioning in case there's volatility there in things like SCHD, which I am looking and very excited to see, tax season come around so I can get some more RSP contribution room. Debating on whether I might buy something like XEQT or VT, some global market ETFs, or continue to cost average into SCHD. But it is nice seeing SCHD up almost 4% now since the beginning of the year, actually trading exactly in line with the S&P 500, but will actually be better performing because it pays a higher yield. And when those dividends come in, it'll boost the total returns on this. And I love SCHD. I know a lot of people have been crapping on it because the performance over the last couple of years has been laggard, but I'm telling you, the reason I own this over a global market ETF is in case there's volatility with my job, uncertainty in whatever, I can, pull those dividends out without selling out a share. And out of my RSP, I will have to pay whatever my marginal bracket is on that money, but I do like having it is kind of some reserve cash flow. And we're not talking huge money. I'm only making $8,100 a year in dividends, but it's a very good position, especially between our combined accounts, which if you want to see those combined accounts, you can go book the courses again at kylelivingston.com. Outside of that, we take a look at VDY. It has not been catching much of a bid, but I think we'll see some better performance this year, which has actually been a better performer than SCHD has been over the last year, mind you. But I think the performance will kick up again when we see bank earnings, with how resilient U.S. bank earnings have been. And now that we've seen a return with things like Royal Bank, Canadian Imperial, to some extent, I think those stocks will continue to perform well. Even TD has been doing really good again, and I think those stocks on earnings will still be better than most people are expecting. And I think we're in a rebound phase, presuming when mortgage renewals come up that we're not seeing continued loan loss provisions being put aside. But I'm still very confident in the financial sector here in Canada. We take a look at some of the other stocks, again, like Google. These stocks, you have to keep in mind, I'm buying Google just like Meta with the perspective of I want to hold these for years to come. These aren't going to be quick flip and flop trades. I don't really care what the stock does. If it goes down, great. It's kind of hovering right around like the average buy price because I think it's right around 180. But since the beginning of the year, it has not been doing much, and a lot of people are getting disappointed with these tech trades. But I still think Google is an incredibly cheap stock, 23 PE. We just got to sit idly, wait for earnings to come out again here, and just see how the stock performs. But I love it for YouTube. It's going to be one of our biggest positions moving forward. Again, I'm not looking at owning too many individual stocks outside of what I currently own, and I will eventually pivot back to just focusing on broad-based ETFs. But I think between Take-Two Interactive and Aduro, these are my shorter term trades. I'm looking at about a 1-year holding target coming into probably the latter half of this year. And if both these stocks and the management is able to execute and what ends up happening the way I think it's going to happen pans out, I think these will be substantial trades. And if they work out, I will be selling them down to reinvest into global market ETFs more than likely. But I recognize these as stocks I absolutely love. Aduro in the clean plastic sector, and Take-Two in the gaming sector. I think both of those have sizable opportunities ahead of them that the markets are just not recognizing yet today. Those are my speculative trades, and they're not really making up huge percentage of the portfolio, but I like buying what I get excited about. And like I said, I wish I was more excited about Chinese stocks. Hard thing to ride, but I can kind of foresee the future with things I understand. As mentioned, I did not understand Palantir. I don't understand what's going on with Tesla right now. I don't understand what's happening with a lot of companies out there. But I do feel like I understand the gaming sector very well. I feel like I do like the telecom space here in Canada, which is why we bought, TELUS as of recently. There's just some things that I personally like. Now, whether that is a detriment to the long-term performance of my portfolio or not, you're going to have to subscribe to find out, because obviously I'm constantly updating and being 100% transparent here. But I sleep very easy at night with my portfolio exposure. And again, you have to keep in mind, as a 32-year-old, I am somebody that has a limited mortgage to continue to pay off. We have absolutely no debts. So I feel like I'm in a comfortable position to take on more speculative risk, considering the size of our combined accounts between the wife and I. And that is something that works from my time horizon, my risk tolerance. Might not be the same for you, but I'd love to know what's in your portfolio. What are you guys doing, and what are your biggest trades of the year? But on that note, stay cool, stay awesome, and I look forward to catching you in the next one.